So how do you forecast the economy realistically? In this episode of the USA Update Show, I'll show you how regular people like you and I can read data and predict our economy better. The three main methods I'll share with you today. First is a big three economical indicator. That's GDP, CPI, and S&P 500. Second, how to understand politics and the impact on economical cycle in 2 minutes. Third, how do you form your own interpretation and action plan? And also, I'll leave the last 30 seconds to answer a question from the comment section. We're not here to predict the future like a god. I'm just an economical geek who likes to dig up reports and stats and summarize my interpretation for you, and hopefully providing you with some new insights. My goal in every single video is to provide actionable tips for you. If you're able to make an informed decision after watching this video, I would really appreciate a free like and your feedback in the comment section. So the first big three economical indicator is the GDP, which is the gross domestic product. It's basically the total value of goods and service sold in a particular year. And think of it as an economical scorecard for a nation. And since it's a scorecard, let's look at how USA has been doing and will be doing based on the prediction. It's not showing on this graph, but the real GDP in 2024 was at 2.8%. And that's a very good number. Really a 2% GDP growth every year is very respectable. Because in Canada, over the last 10 years, our GDP growth might just be 2% cumulatively. So US, you guys are doing a good job. Now, if we zoom in, based on the real GDP prediction, you guys will see that in 2025, the prediction is for 2.4%, 2026 is 2.2%, 2027 is 1.8%, and then 2028 is 2%. It's all hovering around 2%, but you guys can see that the trend started trending downwards and then come back up again in 2028. Comparing with 2023 and 2024, the Fed's just signaling a rate cut in the mid of 2024. So it's actually giving the consumer a lot of confidence to continue to spend and the business to continue to invest in growing their business. So why is the GDP continue to go down into 2028 before it turns back up? And here are the reasons what's affecting the real GDP. And first thing is tariff, because tariff is making everything more costly for the local people or for the foreigner people. So it's not a good thing overall. And second is immigration policy. If the US president decides to decrease the immigration, this might lead to a labor shortage in construction, agriculture, and that's impacting the overall cost and productivity. Now we got one of the big three out of the way. Let's go to the second one, CPI, Consumer Price Index. It measures the average price over time what consumer pays for a basket of goods and service. It's basically the main indicator of inflation. What has the CPI been trending for the last 12 months? You guys can see that this is the all items for the blue line, and the red line is for all items less food and energy. And food and energy actually contribute a lot, so we cannot ignore that. That's why they measure them separately. But from both lines, you can kind of see since the February 2024 at 3.2% or 3.8%, everything's kind of trending downwards. And really, if you look at the deeper breakdown, in terms of food, it's rising about 2.6%. So that's why you're paying more when you're taking out or eating at the restaurant. And the shelter cost is another thing that we should notice is the 4.2% from a year ago, where mortgage rates and rent both climbing, and it's still hitting both renters and the homeowners. And last thing, probably a lot of US people are feeling it, but not feeling as much as the people in Germany, is the gas service, right? The gas service, utility, pipe gas service went up by 6% in the past year. So if you're investing with looking at this, you should look at where the price is going up, because that's eventually going to be translated into the consumer's hand. And if your business owner or investor start looking for more revenue, that means there's more margin for profit, and it's good for business, it's good for their balance sheet, it's good for their financial statement. In return, the stock might actually go up. And now that we knocked the two big indicators out of the way, GDP and CPI, let's look at the S&P 500. The S&P 500 index tracks the performance of the largest publicly traded companies in the United States. And basically, that's the pulse of the US stock market. And as you guys can see on this chart, since 2022, September, really have the last 2 years has been a really good 2 years, where the S&P 500 rose from 3,600 all the way up to 6,100, right? So that's almost double in price. But started about a month ago, the S&P 500 start dropping, right? If we zoom in a bit, it start dropping. And some people are talking about, oh, the stock market's overheated because it doubled over the last 2 years. Something has to adjust. We have a new president. Now the tariff is coming in place. There's a lot of uncertainty. Still stay until the end because I will debunker all that for you. And what's more interesting is that the team from JP Morgan predicted that the year-end forecast for the S&P 500 will go to 6,500. And that's a roughly 13% gain from Friday's close. Now they're changing their stance because it says might not materialize before December, citing a large standard error. Large standard error, okay. Around the figure against heightened uncertainty. So what does that mean? That means JP Morgan thinks that the stock market, well, I can't even pull my chart up to 6,500. Right now it's at 5,580, but 6,500 is about 20% gain. Not only JP Morgan is wrong making that prediction at the end of last year, this year it actually dropped for about 10% already. So that means they have another 20% to catch up. So do you think the S&P 500 will go up another 20% before the end of this year? That is the key question. And if you do, you know where to put the money. And if you don't, you think Trump's tariff will really impact the market and the market will continue to stay flat, or you're not sure where it's going, make sure you review this video where I talk about Trump's 4-year plan after watching the current video. And I'm gonna be straight up with you guys. Last 2 years in S&P 500 has been a smooth ride. And this year in 2025, it will be a very tough ride. It will be more flat or actually downward trend. Every time Donald Trump tweets something about tariff, the market will drop. It could be opportunity, but at the same time, there's going to be a lot of volatility in the market, so it's not for the faint-hearted. What I would suggest that is really taking a step back and only investing in really good stocks you want to hold for the long term, and then ignore the short-term movement. And don't put all your money in one basket at one time, because then if the market keep going down, you're going to feel like you're pinched. And to really feel the pulse of the market, a lot of time, every sector is very different. So I like to look at, let's say, the Forbes report on what are the 5 promising high growth sector in 2025. Again, I don't blindly believe the report, but I take it with a grain of salt and see where the smart cookie are thinking, and does that align with my own investing goal. And it's not surprising that anything in tech about AI and machine learning will continue to be hot. I know there's a lot of saying of overproduction in the chips. Recently, there's some rumors in the market talking about over-investing from these big corporations into AI in terms of software, infrastructure, and all that. Now, what's key is that you have to think about from their standpoint, they rather over-invest than under-invest. Because if they don't over-invest and they're left behind, for example, Google invests less than Microsoft, then Microsoft might be left behind and that gap cannot be picked up because all the speed in AI is so fast. So they rather overinvest. And in my opinion, right now, there's not really of overinvesting, or at least only in the preliminary stage. So nothing to worry about. And now that we talk about the bullish sector in 2025, what about some bearish sector based on all these tariff and all these uncertainty? With all these uncertainty and the tariff in the market, traditionally the things we might buy for fun but we don't really need, we will actually cut back on those. And that's might potentially hit the consumer discretionary sector. Things like Nike, things that you don't really need but you like to look good. So that's why you buy them. Another sector is manufacturing, because traditionally they're importing their ingredients or material to manufacture in US or outside of US. Now their profit margin are squeezed because of the tariff. So invest in manufacturing sector very carefully. If you enjoyed the video so far, I would like to ask for a big favor, which is clicking the like button and subscribe. It's only 2 clicks for you for free, but it really help off the channel. So if you think our channel is worth that 2 clicks, I'll really appreciate it. Now let's get into how to understand politics and an impact on economical cycles. So to understand the politics and the economical cycle, I like to look at big banks report. Scotiabank is one of the big 5 banks, and the wealth management is usually when they're managing private clients with over $500,000, $1 million at least. And there's certain keywords I like to search, but before I go there, I want to tell you guys, do not take this report blindly, because banks have their own agenda too. For example, Canada has been dropping the rate substantially faster than the US counterpart. So that means that the bank want you to borrow more money because they know that the consumer might not want to keep their money in the bank. Instead of getting paid 4% in US, they're only getting paid at 2.5% in Canada. Okay, so understanding from that perspective, you got to read this report with a grain of salt, because banks has to make money, so they have different arms in their business to make money. So while one arm is not making money, they can make money from the other arm. So it might be biased to push you towards there naturally. And how I like to read this report, of these so many pages, so many things in here, so complicated, so many charts, is I like to do one thing. I like to look at what the keywords I need to search up. And one of it is monetary policy. Right? So I search up that, there's 46 of them. Let's read the first one. Okay, monetary policy rate path could soon diverge, heightened by the election of Donald Trump to second president term. So just to keep in mind, this report came out in January 21st. That's right around when Donald Trump went into the office. So they're talking about the divergence of the rate, and we already see it happening, right? US is holding their rate still, and the Canadians are cutting their rate faster. And they're also talking about some central banks like the Bank of Canada and European central banks seems much more intent on boosting economic growth as inflation retreats. That means inflation goes down, requiring a less restrictive monetary stance. Another key thing you're going to notice is an aggressive rollout of trade and immigration policy could lower growth, raise inflation, and alter monetary policy path expectations. So what they're saying here is that even though Canada cut rates a lot faster than US, they can stop the rate and start hiking again. So that's something that a lot of people might not think about, because Canada is in a really weird spot that we're going to have our new prime minister elected in a month from now. We don't know how that's going to go, and I'll let you make your own decision. And that being said, I think the key takeaway is that do not make your investing decision or do not make your economical prediction solely based on the interest rate cut. And also talking about the soft landing comes with monetary policy, right? So the reason why the Fed or Jay Powell is playing around with the interest rates, because the moment they drop the rate too fast, inflation will come back. The moment they increase the rate too fast, historically, then people start losing job and no one's spending money. So this that teeter-totter, they get a balance. And another keyword I like to look at in the report is just type in Trump. So you will see that Trump has 97 search, which is double of the monetary policy. So I would like to show you guys what Trump's really is saying in this report, but what's the point, right? He changes, because he changes mind like he changes clothes, right? So maybe 70% of that is more negotiating tactics, and only 30% of that is real. So you really have to take it with a grain of salt. And before I move on to my own forecast of 2025 for you, I just want to say tariff, in my opinion, in the long term is not a good thing. In the short term, it can be used as a negotiation tactics. That just hurt the country as imposing it and the country that's being imposed on in the long term. And before I go into my own prediction, I just want to show you what the consensus of the rate cut from Feds look like. So you will see from 2024, we're sitting at about 4.38%. Even in the median forecast, you're seeing that it's trending downwards into 2027, 3.13% and 3% in the long term. So they think it's going to stabilize around the 3%. And that's based on the analyst median forecast. And here's my take. Even though the Fed said they were very likely to cut rates twice in 2025, I think they're only going to cut once, and here's why. Even though Trump's policy is going to add a lot of pressure on inflation, the US job market and everything else has been doing quite well and adjust quite rapidly. So instead of dropping the rate for twice, they're probably only going to carefully drop it for once and see how it goes. So I think there's only going to be one rate cut in 2025 and then maybe a few more in 2026 and 2027, but I think it will be slower than what's forecasted by these analysts. And I'm just sharing my 2 cents, so let me know what you guys think in the comment section. And like I promised in the beginning, I'm gonna respond to one of the comments from the previous video. And I want to shout out to Andy Lin 5678 for posting in my Trump's real plan for the US economy video. I really like your enthusiasm as we learn and grow together as a community. Solely relying on imposing tariff on other countries to offset the revenue loss from the tax cut is not enough. And so far from the government spending cut, we hasn't really seen any effect. And cutting government spending can actually shrink the GDP. So I really hope that the tariff is not here to stay for the long term, instead just a negotiating tactics. Because if tariff continue to go on, other countries will react to it. For example, they're talking about leaving the SWIFT system. Other countries like the BRICS, including China, are talking about leaving the SWIFT payment system. And they're talking about replacing with cryptocurrency. So President Donald Trump can play this tariff card until a certain point, but other countries are also very smart at reacting. So the last thing the US want to see is more countries are leaving the SWIFT payment system. Right now, most of the countries who are buying oil have to change their money to the US dollar first. That's why the US currency continues to be the dominating global currency. The moment that less than 50% of the country are using US as a dominating currency, things might change. So Donald Trump has to play this card very carefully as well. So there's my reply to your answer, Andy. I hope you enjoy it. If anyone else have any questions, let me know in the comment section below. If you enjoyed this video, now's the time to go watch my video on Donald Trump's tariff, which is the most viral video on my channel. And thanks for watching, and I'll see you guys in a few days.